Well, the trade dispute escalating between the U.S. and Europe after President Trump threatens to impose tariffs on $11 billion worth of European Union imports. Now, the president tweeting, quote, "The EU has taken advantage of the U.S. on trade for many years. It will soon stop." The U.S. and EU have been in litigation over Airbus subsidies since 2004, and U.S. officials claim that it gives the company an unfair advantage. Joining us now is Dr. Barton, Money Map Press Chief Technical Strategist, along with Annandale Capital CEO George Seay. Thank you both for being here. Dr., I'm going to start with you just in terms of this trade skirmish, I guess you can call it, or trade tensions between the U.S. and Europe. Just last week, the main focus was on China. Now we're talking about Europe. How does this play into, I guess, the coming slowdown that we have been talking about in terms of the global economy?
Yeah, well, it's probably a little bit ill-timed in that this has been going on for 14 years, this battle over Airbus subsidies, and it's coming in now at a time that could be disruptive, but I think it's just another bit of posturing from the Trump administration and the trade team to try to say, look, we're going to be tough on everyone so that they can get some last-minute leg up on the Chinese trade negotiations. So I think that's the bigger thrust that we're seeing here, that this is going to come out of, the World Trade Organization is going to come out with a number. The U.S.'s number is going to have to go down and meet that. And that will all wash out. And we'll see this show up again when we get down to brass tacks in China.
Do you think that maybe this is the Trump administration's effort, or effort just to try and distract all of our attention from what's going on between the U.S. and China? Because we've been focusing on that now for months, it seems like, waiting for some sort of resolution. Week after week, doesn't seem like we're really making any substantial progress on this front.
Yeah, and I guess maybe if you want to look like the tough team, maybe you rough up somebody else that's not quite as rough on the playground. And I think that might be the bigger negotiating gambit that's in play here.
George, let me get your take here. I mean, how big of an impact do you think that this tariff protectionism strategy, or the talk that the administration is having on the U.S. economy?
Not much at this point. Eventually, it'll have quite a lot unless we slow all this down. It's certainly not business as usual anymore, is it? Usually, these things were handled behind closed doors quietly and worked out in a supposedly gentlewomanly fashion. And these days, it's loud, shrill, and out in the public square. And I think actually the Europeans have earned a little bit of this with their underfunding of NATO and their strict antitrust behavior and coddling Airbus for a very long time. So I think actually the president and his administration hitting him across the cheek, so to speak, one time woke him up and was a good thing. But I don't want this to become the new normal, where these trade disputes are aired out in public sighting for everybody to see, and we really get into an adversarial posture with some of our key allies that have been our allies for well over 100 years on a regular basis. I think it's unhealthy, and I think that it creates quite a bit of risk that we alienate countries and leaders of countries that we really depend on in lots of circumstances. So there's a lot to be troubled by this, and I'm again hopeful it's not the new normal.
George, what are you expecting in terms of the expected economic growth? I know I was reading through some of your recent notes, and you were saying that you were calling economic growth is the equivalent to calling interest rates or calling the weather. It's very difficult. But where do you stand right now?
It just can change so quickly. We all were humming along. You go back to ancient days for a lot of people these days, but the first George Bush administration in 1990, and he had a 90% approval rating and went in and dusted up Saddam Hussein and threw him out of Kuwait and was racing to re-election. And all of a sudden we hit an air pocket and we went into recession in late 92, right as he was going for re-election, and he lost. And that was kind of out of nowhere. And so I don't think that projecting whether we're going to grow 3.3% globally or 3.7 or 2.9 is all that relevant. I think what's important is that we continue to grow, and that global trade policies iron themselves out, and that some of these emerging markets that have had a really hard time growing in the last 5 years really amp up their growth so we can turbocharge the number we're getting. The last thing we need is a giant geopolitical disruption or a continuing major trade dispute or something else that would not only slow down growth but eliminate it. And that's the wild card. I think the political and military and country squabble risk is actually the biggest risk right now. I don't think oil prices are going to get high enough to really disrupt the global economy, and I think there's lots of positives out there. So we just need to avoid any prolonged turmoil between our country and China and other big players.
Well, reading that we did get on the global economy was from the IMF today, cutting its global growth forecast for 2019 down to 3.3% from 3.5%. The organization saying that growth expected to recover next year unless, quote, policy missteps get in the way. And DR, I mean, the big question here is this any cause for concern? Does this make you maybe hesitate just a little bit?
Well, I think it brings to light some of the impact of what we've seen with the trade disputes and with the tariffs, clearly. And I think the issue, the fact that they downgraded Europe, they downgraded China, they downgraded the U.S. as well, actually, is a cause to look up. But as George said, that can change so quickly when you look at the Atlanta Fed, who has just a really good model. Their model bounces a lot, even though it's really good. And so when we see something like this, it's very important to remember that they said while these things they're downgrading these economies by a bit, they don't foresee a recession in the near term, meaning in 2019. So I think that's a positive thing. I think if we can turn around the Chinese trade thing, China's manufacturing already ticked up last month, which is a good sign. So I think we could get to a neutral stance on not dropping these growth numbers anymore, which would really boost the markets.
Yeah, George, at a time where there's so much uncertainty, we've been listing out the number of risks that are facing the U.S. economy. At this point, when you're talking to your clients, what are you advising them to do?
Lower your expectations. We've had a 10-year bull market, and it's not going to go on forever, although it may perpetuate itself quite a bit longer than anybody's really been expecting. But we're telling everyone to stay balanced and stay rational in terms of what you're expecting, both from risk assets and non-risk assets. And I would say one thing ironic about this lower expectation for growth, which may prove to be accurate, is that I think the last leg up in the rally we've gotten is a big byproduct of interest rates dropping so much, which is a reaction to slower anticipated growth. So ironically, we may get a slowdown in the global economy, but it may precipitate further stimulus from our government and our Federal Reserve and some of the overseas countries as well, which may be a buttress and an enhancer to the stock markets around the world. So that's the ironic thing about markets is maybe you do get a bit slower growth economically around the world, but stock markets react in a positive fashion because there's no alternative. Fixed income can't compete.
And George, we heard President Trump calling for or saying that he wouldn't be opposed to that if that in fact did come true. So DR and George, thank you so much for joining me today.
Thank you very much.
Great to be here.